Good afternoon, ladies and gentlemen. Thanks for joining us. This is the Hidden Levers War Room for October 2018, Business Cycle Sunset. My name is Raj. I'm usually joined by my co-founder, Praveen Gunta, but he's serving jury duty today. So we have a new recruit. His name's Andrew Miller. He's one of our economists. Used to be a PM at a multi-billion-dollar shop in the Midwest somewhere, but he came to us and he wanted to go to fintech instead of manage risk. So here we are. Andrew, thanks for joining us today, and we'll be talking about perhaps the end of this business cycle, which people have been anticipating sometimes with fear. Let's do it. The War Room is a session that we do monthly. It's for continuing education credit, where we update the scenario library. Top-level economic research really can't do that at asset managers like BlackRock or Russell or whoever. We can tell the truth. All we got to do is sell the tech that communicates that. So these scenarios are exactly what feeds Hidden Levers stress testing, so you should know about them. With everything we do, there's a good, a bad, and an ugly outcome, so you can maintain your fiduciary duty and check your egos. We are doing exactly the same every day as we do the analysis. Let's see what today's War Room is about, the end of the business cycle. So we'll talk a little bit about 101 about business cycle. We don't want to bore you. We also have covered that before in Fed rate hawks in earlier in this year. So we'll talk about what is the big thing contributing to this downside push. Is it interest rates and all the noise that's coming in the executive branch, maintaining that interest rate hiking path? Or is it tech? Is it tech just being bloated and falling all over itself? Which one of those is the real culprit for this downturn? We'll finish by updating that tech scenario that you guys love, tech bubble, on Hidden Levers, and then introduce a new, more cohesive scenario that combines a peak in the fangs, perhaps, along with interest rates. And we call that business cycle sunset. So let's take it away. Andrew, if they only have 5 minutes, let's tell them what they have to know so they can get going.
Sure. So the main things that we're gonna touch on with the business cycle are, what are the parts of the business cycle that could be indicating a sunset, and we're gonna touch on things like the technicals, the FANG stocks that get so much coverage in the news, and then also the Fed and all of the talk around Fed rate policy.
We have to be really careful, because we don't want to call a top or anything. We don't want to say, oh, the market's about to crash. That's foolish, right? But there are things that make this super ripe. It isn't just the fact that the market's crashed through. I mean, it is technicals, right? Way before yesterday's 4% NASDAQ down day, you had all that. You can see those little red bars there on the candlesticks. They're riding, and so that's a telltale sign of more downside to come. Those little wicks, the longer those are, the more volatility there is. That tells you downside's coming. Very much a change in direction than those previous months where it's just these little nuggets of red and white, right? These bigger bars are, that's the idea. Is that what's going to come? Probably that is going to happen, right? You do have, in technical analysis, you do have the same. The biggest moves come at the end of moves. And so that, if that slow melt up that we've had the past few years, and low volatility, super low volatility for the past 5, that had to end sometime, and that's probably now. The other reasons it's ripe, you have multiple folks talking about the Fed's way back when. Was QE the right decision? Is this the right decision on interest rate hiking now still? And so, for the executive, they just want to look good. The market's just folks that work in the markets. They just want to look good. They want the melt up to continue. But the path has not been that. So a lot of people hating on the Fed right now, and business cycle sunset becomes really ripe. From the days of Amazon being just a bookseller all the way to now, it's just a universe away. Even Hidden Levers, we've been around 9 years. We are a universe away from where we were when we started. And so that's that. Rounding it out back to the Dow, folks get really happy when they see the Dow, which is not as relevant an index as the S&P always. But they see the Dow kind of breaking through its early year high, right? It just didn't keep up with the S&P, but now it does. Well, guess what? That formation, if it really breaks through on the first time, that's that's more rare. It's more 2 or 3 times it needs it. That kind of M shape for technical analysts is very much called a double top. At double tops, that's hard resistance that you can't get through, a ceiling that you can't break through. You need to bust through it 4 or 5 times, and then you bust through. And so, that kind of formation now, you're seeing the M. That very much makes sense to any technical analyst as a very bearish kind of pattern. Okay, and if I map out, like Andrew, you've shown the 1 year time frame. How about the all time frame? What does that look like? So you can obviously see that giant M right there. We've of course put that behind us. Starting in 2010, there was an absolutely new pattern emerging that's gotten us to where we are. But technical analysis pretty much remains there. When you have that double top, you're looking at one of the most extreme bearish things that can happen. And so the double top on the Dow makes this we felt confident that we could talk about a bearish scenario on business cycle. Whether it's a correction in tech or whether it's a full out hell to pay on the QE stuff. So,
and with technical analysis, one thing that I've heard people say a lot too in the past, Raj, is that even if you don't necessarily trade based on technical analysis, that there's so much money in the market that does, that it almost doesn't matter if you trade on it. It's still going to be important to what you're doing, because there's just so much money in the market that will trade on it regardless of your particular views on it.
Yeah, and you don't have to be some quant genius. Just be able to tell pictures and know what an M looks like and maybe what a W looks like. Those really come in handy. Support levels, resistance levels, that's the thing. All right, so if you let's get started. That's basically the summary of what we're going to talk about. Do we want to look at what's where this scenario lives on the platform? Let's show them that.
Yes. So we have a new scenario that's been released with the same name as the webinar, Business Cycle Sunset, and we can take a look at the details of that. We have a few different outcomes for this time. We have on the upside, we have the tax plan reset cycle, and then the bad outcome of retesting the 2018 lows, and then the ugly outcomes to this time of peak fangs and Fed's QE karma. So we'll go through some different aspects of those.
Why don't we take a look at where the S&P is right now? For all the single day bleeding, let's take a look at where we are in context of the year.
Yes, and as you'll notice, the progress on the scenario is actually already over 50% on the retest of 2018 lows. So we're already, as anyone who's had followed the market this week knows, it's been a continuation of the trend of heading towards retesting those lows, and we're about 2/3 of the way there currently. If we take a look at the S&P year to date, on the charts, we can see that as well, that we're not quite back to the lows of the year, which were down around 2581 a few different times, or a couple different times there, and currently not quite there, but back to about where we started the year at this point.
Yeah, the nice thing is clients that are worried or anything like that, rather than the fear mongering of the headlines, just show them that, and the technical analysis idea of support does come back into play there. Those twice tested lows and rebound should be solid support. And so that is we usually don't have multiple downsides. We have a good, bad, ugly construction, but the retest of the lows looks pretty inevitable. And then it becomes, that's something to talk to your customers about. What does things look like as we lose that? And then how much of that is baked into the cake? How about VIX, Andrew?
Yes. So the other thing year to date that often comes with market downside is also an increase in volatility. And similar to the S&P, we are back to higher levels, but not quite the highest levels that we've seen this year back in February. But the VIX is certainly higher and has been staying elevated. It's been above 15 for almost the entire month at this point, since the first week of October, basically. So definitely higher volatility in general as well.
All right, so we'll come back to this scenario and after the kind of education session. Let's get back to the analysis. So first things first is if you have only a few minutes, just know that the reason business cycle sunset is so important right now is because that tech crash really just got real. If it is the third time that we are facing these same lows in the same year, then that means that it's just a super change in character. And so, that means something more like the year. It's ripe to talk about the year 2000. We try not to talk about the tech crash like that. We usually just stay to a 10% correction would be very healthy in tech, but the way things are right now, it is much more significant than just a 10% correction that would be healthy while we take out weak hands in the market.
And it's a conversation that we at least need to be equipped to have with the data and with the tools available, even if it's not necessarily something that we're predicting or that you think is going to happen. It's still something that's important to be able to speak to and have a notion of what the risks are if something like that does happen.
Yeah, and actually one of the things that I forgot even is it becomes super ripe to talk about this stuff because the retail cash on the sidelines, that all that stuff was waiting on the sidelines for that opportunity to come in 2015. Well, guess what? At the online brokerages, every one of those, their cash accounts for retail are at record lows. So all that money is now in the markets. And as we know, dumb money comes in at the end. Retail money comes in at the end as institutional investors tend to go to the sidelines. They trade sides. That's another historical pattern. So many of these things are just history. In essence, yes. If there is a sunset, that would be a normal thing every 10 years. That's happened since 1850, and so now we haven't had one since 2009. Officially, we're past the 10-year mark, but just barely. So if
And speaking to some of that as well, Raj, I think we have Bernanke here on the slide as well, and I think that's one of the big unknowns right now for a lot of investors are what will the implications be of policies like QE and zero interest rate that we haven't had a historical comparison for in an exact apples to apples way. That's a real unknown right now in terms of the historical record of eventually there will be a recession and a market downturn, and what that will look like is more of an unknown than usual.
Right. Is this going to exacerbate it? Let's move on.
Sure. So next we're going to talk about the business cycle and rates. So when we talk about the business cycle, I think the chart on the top right here, everyone's probably familiar with or has seen before, the notion of the different sectors and sector rotation that align with different phases of the business cycle. And as Raj mentioned, the recession every 10 years since 1850, and the fact that we're now basically on the edge of that and about to violate that pattern if we don't have a recession in the very near future. And one thing that's interesting, I think, on the sector front, at least to me, Raj, is the technology sector in particular, and how much talk there's been around the FANG stocks and just technology stocks in general, and how well they've done. But the fact that technology is the sector that's getting all this attention is not historically something that's associated with the later part of a business cycle. It's typically a very early business cycle indicator.
Yeah, well, maybe it shows not just the bloat, but kind of the tech takeover of mindshare, and as well as how our lives work, right? Technology
yes.
Before was maybe the Dow and all that. It wasn't Amazon. It was things in the Dow. Sorry.
Exactly. Yeah, it's a redefinition in some ways of what we think of as technology, because something like Amazon that everyone thinks of generally as a technology related company, but trying to fit it into the traditional industry buckets is tough. as especially as the amount of things that Amazon sells and the types of services they offer continue to grow. Fitting them into one bucket becomes more difficult, certainly.
Yeah, and that just goes to show maybe this chart is totally irrelevant because the word technology isn't some little bucket anymore. And that might be another case. If on the positive side, there is a case to be made for a business cycle reboot or business cycle disruption. It isn't just the huge tax regime change that could make that. It's also societal change on what is considered tech. What is maybe there is just one mother corporation or a handful of corporations that run our lives, etc. Mm-hmm. That could change the business cycle. On the left, that comes right from the government, the National Bureau of Economic Research, and from the 1850s, showing basically every contraction. And so that is the proof that every 10 years there has been a contraction. What are the standouts here? Well, one is, you notice after the 1940s, the contractions are single digits, under 5 actually. And so that's when the Fed became a reality after World War II. And before that they did exist, but the real policy stuff, around making a contraction, which is negative GDP, making those periods shorter and smaller. I mean, before that, it was the Wild West. Just imagine losing half your economic output in 1 year. That's or 25% of it. We were a banana republic back in those days.
And like you noted at the bottom, it's not surprising that our terminology has evolved from panic to depression to now more commonly just recessions. That less than 5% certainly does not involve the type of panic that some of those numbers from the earlier 1900s or even the 1800s would elicit in today's economy.
Yeah, the reason we circled the 5% is, if you remember, that stock market crash was immense. The GDP hit wasn't that bad compared to what we faced before the Fed's existence. So, for all the haters on the Fed right now, including the president, and definitely including some of the editorial boards who are talking about, that kind of payback is coming, regurgitate, kind of throwing up all of the quantitative easing karma. They have done a marvelous job of making contractions smaller and making them shorter than they otherwise would. All right, so that is the 101 of business cycle, how that works. Let's talk about the rate cycles and compare different cycles, how they've gone. Why is this one different?
Yes, I think the chart on the right does a really nice job of visually showing just how different the Fed funds rate policy has been coming out of this recession and heading into a new business cycle after the recession. That the rate at which the Fed funds rate was increased in previous instances over the last 20 to 25 years have just been so much faster than what we've seen so far from the Fed since the crisis.
And not only is the rate hike cycle faster, but that time, you can see, I mean, that word slow there, it goes from 2010 all the way to now. A lot of that, they weren't even raising rates. They just kept them at zero. So that's the big new piece to reckon with, and although markets seem to have forgotten maybe who Ben Bernanke was or what happened in 2009. We did a 10-year look back at the financial crisis just last month to kind of celebrate that anniversary. And that zero interest rates policy, you don't hear that often anymore because markets are up, right? The real economy is taking over. CapEx spending is really optimistic. All the tax money that companies are saving, they're going to spend it on new employees, et cetera, et cetera, et cetera, including hidden levers. But nonetheless, that was a big Hail Mary. That was not a orthodox move. That was the last move, a move of last resort, really, to take things to zero. If we go to the next slide, you can see there that that there was several parts of the Fed game plan at that time that were just completely out of the blue, and the rest of the world followed that. Do you want to talk about the fund rate cycle and why they kept it twice as long?
Sure. Yeah, I think that was on the last time we were talking about kind of the speed once they began raising rates and how much slower that has been. But also on the other side of it, the amount of time between the end of the recession and the first rate hike has been twice as long this time as in the previous two recessions. And especially in the case of the early to mid 2000s, that was already a period where people are often critical of the Fed's policy during the 2000s as a potential factor in the financial crisis, that they kept rates too low for too long. But relative to the current environment over the last 10 years, that is a relatively brief time period, actually, only about 32 months between the end of the recession and the beginning of interest rate hikes resuming. Now, that was a smaller recession, and there were certainly a lot of differences, but I think it is an interesting difference and contributes to what we mentioned earlier, which was that there's a lot of uncertainty about how these different policy decisions will play out, because there just isn't a historical comparison for them like there are for typically most Federal Reserve policy decisions have historical analogs that we can look to that are closer than we have for this one.
Well, and that's really why stress testing exists. So if you think about
Yes.
it, that middle green arrows, right, between that early 2000s recession, and there was a hell of a lot of flack on the Fed for keeping rates too low for too long for that 32 months. And so there's also a lot of a lot of scholarship on that keeping rates too low for too long in the early 2000s is what led to the financial crisis, right? If I can paint the picture for you, keeping rates really low brought in a lot of dumb money into housing, a lot of foreign dumb money. And so it's like, oh yeah, the whole world was investing in housing. There was an Oscar nominated movie about it, right? So that was all triggered by keeping rates really low and making housing seem sexier than it was. Once that rate hike cycle, the slope there in the middle of the chart is still pretty quick, right? So they waited a while longer, but they still raised it pretty quick, and so that killed that housing. It kind of pierced the housing bubble and maybe the market. So here now it's just double that. So on the downside scenario, which we'll talk about at the end here, if there is hell to pay for the quantitative easing Hail Mary, then what does that look like? That is the $1 million question.
And in terms of the balance sheet itself, one thing that has been talked about a lot, but there's often not a lot of specific numbers put to it, are the process of unwinding the balance sheet expansion from quantitative easing. And so we looked at the size of the balance sheet and also relative to the overall GDP of the country, so that it wasn't just a nominal value, but also has a little bit more of a reference point in terms of how much of an anchor it could be on the economy as a whole. And we certainly have made some progress. And the chart at the bottom left here ends on January 1st, 2016, but it continues on that trend line. Basically, they've continued to wind down, but not enough to get back anywhere near the existing trend line. We're still in the neighborhood of 20% of GDP as the total size of the Fed's balance sheet, relative to a long-term norm of about 5%. So there definitely is a lot more on the balance sheet currently. And once again, it's not necessarily a bad thing. It's just another form of uncertainty that there isn't necessarily good precedent for in terms of what kind of impact that would have on the economy or the markets if we do have a recession prior to the balance sheet returning to a more historically normal level.
All right. Let's talk about the impact of those rates on housing. So definitely we've spoken about in the past few months, this new Fed hawkishness is taking its toll on on housing and emerging markets. Those are really standouts for us, right? So let's consider housing here. You can see home sales and mortgages, those are inversely correlated, just no nonsense. Those two red arrows pointed at each other. And then that's really the interest rates are what's keeping what's hurting housing, right? If you look at, there's other kind of tailwinds behind housing right now. That there's somewhat of a shortage. We do have a growing population. We do have household formation is increasing. So you should really have home sales going up. Yet it's just, you can see that dotted red line there on the bottom left, and it's just not busting through that. Those housing starts, we aren't creating enough housing, or there it just hasn't skyrocketed like you'd think with all those things behind it, especially as prices are going up even.
Yeah, especially relative to the prices, I think is the most surprising thing about the housing starts number to me, because a lot of the major metro areas across the country have had a good run here of multiple years of really strong home price increases. But the housing starts nationally just haven't been able to get back to normal levels for a late cycle expectations for the economy.
Right. Yeah. For this place where we are in the business cycle, let's say we are near the sunset, you'd feel like we were humming at kind of, all pistons go on housing starts. It's the opposite. And so,
Yeah, I think it certainly is one of the contrarian symbols, kind of along with the sector rotation stuff we talked about earlier. That in terms of making a case that maybe the sunset is still a little bit off in the distance, that housing starts, we would expect to see them be more euphoric or at least above the long-term trend to be consistent with a normal cycle.
right. And so maybe that boosted cycle through tax plan, the real tells about when sunset's coming is going to be when housing starts do reach well above that red line to their historical highs.
Yeah.
If you notice the graphic there, we've put it on the page 3 times, a previous page.
Yep.
It's to show that interest rates lock in where home sales are going to be. Just have that graphic for yourself or for your clients, or perhaps for your clients' kids, to explain. They may be coming out of college or trying to find an apartment to buy, whatever that is. Graphics like those hit home for a lot of folks way more than the jargon that you're used to, that they may not know at all. All right, so we did have a blog piece earlier in the year about, are we in the business cycle twilight zone? That expansion chart on the right is so telling. You can see that 2009 is the kind of taupe line toward the bottom. This GDP expansion, although it's the longest by month, so it goes well outside those gray shaded areas, it's still pretty low. So it's like long and lackluster, when it comes down to true GDP expansion. If you look at the lower left there, the duration is in green, and that's where it's like, well, from the 1960s and 1990s, those were great eras from America in terms of economic pushing, push forward. But there was no soft landing. You can see that, right? So for all the talk we hear about a soft landing now, that might be suspect. So, with these big pushes in the economy, they're on the stock market performance, that correction it's not a soft landing. So, if there's wishful thinking about a correction that's just 10%, that would only be a correction within a continuing expansion. So if there's a small correction in tech where there's a business cycle that's still going forward because of the tax plan, then you can articulate something that abates after 10%, maybe 12 or 15%, like it would be healthy, right? Here, though, if there truly is a sunset on the business cycle, and we're going to get a proper contraction, then you're looking at a much deeper S&P correction. Andrew, do you have anything there?
No, I think that's all the key points I had. The only thing I would add is that I think the capacity for a stock market pullback without an economic recession is certainly greater than most of the historical periods, just because of that disconnect on the way up, that the S&P could plausibly have a more significant correction than we would typically see without an economic recession, but potentially coexist given the set of circumstances. So I think that'll be something interesting with the as it all plays out to see if that relationship is different on the downside, since it was so different on the upside as well.
Okay. You see there at the top left, we continue that conversation where the rate hikes have they have their inevitable impact on housing. Likewise, they have their inevitable impact on foreign currencies. We discussed that a little bit. I think earlier, maybe sometime in the summer, we discussed the emerging markets hangover. You can revisit that. But we're still in the same place there because of that rate regime. And so the Fed has wanted to cool things down, tamper things, probably inflation, as the economy goes into high gear. And they care about that much more than housing or foreign currency or emerging markets futures.
And while that's not a positive for those emerging market economies, certainly it could be another one of those factors that we've been building up in terms of those reasons for optimism that come through in some of the data, that the strength of the dollar could, in terms of the domestic economy at least, be a tailwind to help not have a business cycle sunset in the near term. Unfortunately, in this case, the collateral damage might be that some of the emerging market economies would bear the brunt of the trade-off there.
We're getting a question, actually. Can you discuss other
sure.
signs of potentially changing market psychology as well? Greed to fear. I think it's more like just greed. The fear is for the people that have seen these cycles before. And so, I'm usually a pretty even-handed person. I'm a little bit more bearish now because I see the greed. And so, what is that greed? For me, the biggest telltale is money on the sidelines on the retail side is at its lowest in history, right? It's not just lower than it was ever at the bottom of at the height of of 2008 boom times. It's the lowest. That means people are not keeping their powder dry. They are fully invested more than they've ever been, and so. That's not an anecdote. An anecdote is my 76-year-old dad buying tech stocks, which he hasn't done since 2002. So that's anecdotal. But data is when all the brokerages report that their cash accounts are at record lows. And that's what
I do think one thing that'll be interesting to see there is that in this, along the same lines of the retail investor often being a late indication of where things are, there is a chance that the retail investors' movement away from cash is actually representing a late realization that they haven't been receiving any interest for the last 8 years of sitting in cash, more so than a desire to jump into stocks late. So I think there's an interesting juxtaposition there as well of what is the motivating factor? Is it the finally realizing that zero interest rate policy was in place for so long and that cash wasn't paying anything? Or is it a desire to get in on a stock market that could be late cycle? And I think that's not normally a choice that presents itself because of zero interest rate policy being fairly unique in that regard. So we'll see how that plays out as well. Now that interest rates have started to rise, if we start to see some movement back into cash once the rates are a little bit better, it could be a positive sign that there could be some economic growth to come still, and that the movement away from cash had more to do with rates necessarily than the business cycle or the equity markets.
One other sign of greed or that in terms of a telltale sign I see is removal of money from hedge funds. We're hearing of I don't know if it's any records, but quite a few hedge fund closes in 2018. And so where's that money going? It's going into non-actively managed funds, right? Index funds. And so that's a sign. I'm not sure if it is a sign that deals totally with the business cycle. To me, it's more about a potential liquidity issues, right? That could be another scenario that we create by the end of the year, actually, a liquidity crisis, because everybody's in the same darn investments. So, when you do have people running for the exits, then if everybody's in the same thing, if everybody's on the same side of the trade, then there isn't the kind of aggravated downside when they leave. So that might be something. But the hedge fund record hedge fund closes, that is somewhat telling to me. That was just to answer that question. Okay,
Sure.
Let's go to the tech side of things. I know people are wanting some wisdom on what the outlook is for the FANGs or for tech, and is this just a momentary thing to get out weekends and then all the party's still going, or is it very much a change of seasons? And so,
Sure.
Yeah, let's talk about that in a quantitative way, right?
Yeah, and I think one thing that you mentioned early on, Raj, was that there's always that temptation for any conversation about the FANG stocks or tech to lend itself to comparisons to the 99 and 2000 era of technology, and so as part of that, we took a look at how does it compare in terms of the amount of the S&P 500 that is in technology stocks. And at least currently, we haven't reached quite the same levels as 99 2000. We're still a good bit below, around 25%, compared to nearly 30% in 1999. And I think the absolute values there are informative, but I think the chart here is also good to note as well in terms of the way that we've gotten to this number. It's been a much slower, steadier increase towards the current value of 26% compared to the 90s, when the percentage was skyrocketing on a almost quarterly basis towards the end of the decade there. And so it's been it has a more sustainable look to it in terms of the slow and steady buildup compared to that rapid buildup of value that we saw in the 90s.
But if you do look at that yellow bar across historical sector weightings, I mean, you're never talking two handle except for in the extreme case of 99 and 2000. And so it went back to the mid-teens in terms of percentage weighting in the S&P, right? So here,
yes,
although 25, is it still comfortably below 29? I don't think so. It's still in the high 20s. And so that you have to ask yourself, is it because of the overvaluation that's somewhat akin to 2000, or is it because tech, that societal existential question of what is technology in our lives now?
Yes.
Yeah, so it goes back to that question. I'm a numbers person, so I think they're pretty close, and so it's.
And speaking to your numbers side, there is one just as a small note, not something that we'll dive deeply into, but something to be aware of in the fourth quarter here that will become a story, I think, at some point, is that some of these numbers are going to start to look a little bit different because the GICS or the GICS classification system is actually being reweighted a little bit to account for some of these changes in technology companies. So there is a chance actually that the officially quoted number for technology companies could actually come back down a little bit, just purely based on that change to the kind of primary classification system that's followed there.
It's just interesting because as Goldman Sachs says, every company has to be a technology company now, right? I'm sure several of the best run RIAs in the land are hardcore technology savvy RIAs, so they're technology companies. Any energy company that's successful today, the MLPs or the kind of shale companies, those are tech companies in a way, right? So it just depends on what that classification means. So
Sure.
because in 2018 we're such a tech heavy society, maybe just having tech as its own sector is a silly idea now.
Yep. So I think it'll be interesting to see if how some of these models change a little bit as they start to tweak some of those definitions to try to better represent the reality of the economics.
Yeah.
So we can continue on if you like.
Do you want to talk about what's going on here in terms of the few contributors to most of the S&P returns?
Sure. So I think this is something that gets a lot of coverage in the media, and I'm sure everyone hears a lot about. The FANG stocks. It's a catchy acronym and gets brought up a lot. And how much of the S&P, both in terms of the market cap of the now $1 trillion stratosphere companies like Apple and briefly Amazon, making up about 14% now of the S&P just among the FANG stocks. And also what that looks like in terms of the S&P returns so far this year. So in terms of how much of the S&P 500 returns are coming from just the top 5 contributors, it was so far this year through the end of September, 42% of the return. And the longer term average since 2000 is about 25%, which I think is actually higher than most people probably would expect. That I think it's a little bit counterintuitive that on an annual basis that much of the return is coming from the top contributors, but that is actually fairly normal for about a quarter of the return to be top heavy like that. So we're certainly above that level, but not actually as much of an outlier as maybe the coverage tends to make it sound. And another interesting note there is that the top 5 contributors to the S&P 500 return are not actually the FANG stocks exactly. They do include 3 of the FANG stocks, but Microsoft and MasterCard are actually 2 of the 5 top contributors, along with Amazon, Apple, and Netflix. Google and Facebook have not been top contributors. Facebook, in fact, has had been on the other side of the balance sheet for a lot of the year on the S&P 500 returns.
Do you want to bring up a FANG's ETF perhaps for a second?
Sure.
It might be talking about some of the volatility in those lately. That's what I notice is different. It's there is so much heartache followed by euphoria the day after lately, and that is truly a change of character. There's of course with this kind of melt up, there's going to be people that were taught to buy the dips, right? They were taught to buy the dips. So especially on tech, they might see it as their entry point. But let's take a look at that volatility to see if is that worth it.
Did you have a specific one you wanted to look at, Raj?
Yeah. Why don't we search for FANG ETFs? Do you want to show the new search function? Actually, that might be a new something we can do to kill 2 birds with 1 stone. We do have a nice kind of advanced search function. Let's showcase that.
Let's see.
You want to explain what's changed about our search?
Sure.
How mature it is?
This is a project that we've been working on that we're getting ready to roll out to just add some new search features to allow the filtering of search results dynamically. So anybody that's used to searching in the system, this will be the first time in a while that we've made a big change to the way that search works, but I think it'll be a big improvement for day-to-day usage and being able to find things, especially if you're looking for something with a very broad name. Like if you're looking for an iShares ETF, but you're not sure which one, it'll help you start to narrow it down a little bit easier if you can filter down to just ETFs or things like that instead of having to search the whole universe at once. So
and
it appears that none of them have.
Too. That's a nice thing.
Yeah, and also portfolio level. it appears that none of them actually have FANG in their name officially.
Okay. Well, so any sort of
We'll just use, but we use XLK just as a technology proxy for the moment.
okay. Yeah, the idea there is I'm just looking for, is there a change in character through the volatility? Are there extreme moves up and down?
Sure. So it looks like the volatility has been, let's go a little bit shorter term here, back to just year to date. So it's been a little bit more volatile than the S&P as a whole, but nothing too crazy. Let's take a look and see over time what the volatility has been. So we're at about 20% currently. And if we go back to maybe the last 10 years overall for the XLK, it's been about the same. It's only slightly above actually its 10-year value for volatility. So at least so far, nothing, not a big uptick certainly.
In terms of the big movements, then the past year volatility has been not that different than the past 10 years. Now if we go to the past 3 months, how about that?
Yeah, let's take a look. July to October, still 20%. So it's been pretty consistent in terms of that roughly 20% range on the volatility, it looks like.
Okay. Well, so then, maybe the bearishness on tech is overdone.
And I think it's definitely been a sector that has had winners and losers over time. We had a question brought up as well about the differentiation between companies like Microsoft or Cisco and versus Facebook and Amazon. That that a lot of times tech is talked about as a monolith, but there are a lot of different things going on among the different companies, and the economics of the different companies are certainly different, even though they tend to get lumped together as a sector more maybe than most sectors would.
Yeah.
You don't hear the other sectors of the S&P talked about in aggregate quite to the extent that you do of tech. You hear more of the main names maybe in the sector, but talked about as an individual equity, not being lumped in as part of the whole sector.
Right. And so in terms of the NASDAQ type, that comparison to 2000, you just have to remember, where are we on, places like Apple, it's still well above a $200 stock. Netflix, it's in a short time, it's come a long way to almost touching 400. And so if it gained 400% and now it loses even 20%, that's you could say there's valuation changes and all kinds of overvaluation, or you could say, well, we're in the throes of an adolescent tech economy that is still really maturing, and as they mature, we're kind of realizing their pervasiveness in our lives, and those movements are kind of like adolescence of life, where it's not exactly pretty, but there's a lot of growth spurts. Those are painful sometimes. So that It could, I'm trying to be as even-handed and not overly bearish, but also articulate why things like this could happen, even though the story is intact. I mean, we are seeing CapEx spending going up across corporate America, but definitely in technology, there's still tons of hiring. So as long as those things are intact, tons of hiring, these market vagaries may just be that.
And I think one last thought on the tech thing too, comparing to 1999, is that certainly companies like Amazon get talked about in terms of how long Amazon hasn't made money and things like that and hasn't been profitable. But for the most part, generally speaking, across tech, the amount of companies that are at crazy multiples and not bringing in a meaningful amount of revenue and profitability, it's just not even close to what it was in 1999. And you have a lot of companies like Microsoft and Apple that are very profitable.
We thought about doing a slide on the dead unicorns, let's say like a Theranos or all those types of companies that kind of went went under. And then also their public company counterparts. Let's face it, just because Snapchat is public or just because Blue Apron is a public company doesn't mean they're successful. That was foisting their failures onto the to the public investor. That's what it was. But that is so not even an issue that it's not worth a slide in this deck. That even talking about is it a tech crash coming or an interest rate related downturn, right? That didn't even make the cut.
Yep.
Okay.
Let's head into our new scenario and our updated scenario to wrap up here.
I guess that, if markets are efficient, then they're dealing serious blows to the tech companies I just talked about that are public. The real IPO fails and some kind of things that are just mediocre performance. So if Definitely. You're seeing a small correction if you're seeing a correction in the FANGs, that's quite different than those IPO fails that aren't worth talking about. Don't lump them together just because it's one bucket of tech. Okay. So I guess as we introduce the scenario, the idea is, okay, we did have this regime change on taxes that's once in a lifetime, once in many generations, really. I mean, the kind of changes to state and local tax, the real cut for LLCs, not just public companies. It's really game changing. Control Alt Delete on the business cycle. So is the business cycle that we've known, that kind of ebb and flow, that contraction and rising of markets and rising of economy, is that completely off the table now? Are we going to reboot that? We've got a lot of things that substantiate calling it a reboot, right? Even with this correction that we're seeing in markets, it has not changed corporate management's outlook on CapEx, right? None of our enterprise engagements are pulling back. Even our own plans on hiring or spending money for our CapEx, that has not changed. I could care less what happens in the market, at least for another probably 20% before I change my CapEx or hiring outlook. And then, the one of the biggest things is the tax cuts are inspiring huge buybacks, and so the EPS is going to go up with those. That still hasn't been priced in, or that those EPS numbers haven't reflect that. The market may well be pricing it in.
Yeah.
And so
I think it's certainly there's a strong case to be made for the upside scenario here. There's certainly a lot of indications in the data that would support the notion that that this is a very real possibility, not to be discounted.
Okay, well, so let's talk about how that macro risk parity plays out, right? The retest of the lows we think is pretty inevitable. That's just how markets work like that. So that retest of the lows from here, as Andrew had said, is somewhat priced in. So we didn't include it here in our good, bad, ugly dichotomy or trichotomy, whatever you want to call it.
Yeah, it's more just a healthy market fluctuation at this point.
Yeah, retest the bottoms, make sure that foundation is there, and maybe rise up or at least stay there for a while. All right, so on the good side, we're looking at a reset of the reset of the business cycle and the kind of paradigm that we've been in of the ebb and flow for the past since 1850, I guess. That comes undone because of the tax plan, right? And maybe some societal changes with tech that are honestly too big for a war room. Well, maybe could do it in another war room, but it's probably better for CNN weekend shows. In this case, the S&P would go up about 30%. The Nasdaq not as much. They have risen. The Nasdaq has risen immensely, and so it would just not go up as much as that. As much as the a mainline industry, those kinds of things. But as I said, that's mostly based on CapEx, tax buyback, stock buybacks, etc. On the baseline scenario, if FANGs have peaked, at least for the next half decade, if they have peaked, then you're looking at a very strong correction, a 1/3 haircut for the S&P, and an even bigger haircut, and that is from right now for Nasdaq. What happens there? Those big leading companies, the idea of FANGs just disappears. I mean, let's face it, Andrew. What were the big five companies in '99? Microsoft is still rocking it, but it was like Cisco and a bunch of others that I don't even remember them off the top of my head at the moment. And so, will FANGs be in that same position? Yesterday's news. You can see Facebook kind of like not being able to crack the 150s anymore because of not just because of its own fundamental mess, but because maybe the ad revenue model is just out of favor, not like it was before, right? And so that's the kind of thing we're talking about. So peak FANGs, meaning FANGs popularity, it just ain't there like it was. And then on the ugly side, it actually says bad. We should probably say ugly, right? It's good, baseline, bad, but really the language we should use is good, bad, and ugly here. That's the yin yang symbol there for you. The idea that, okay, once the Fed put out all that quantitative easing, it kept rates so low, it really took a punt at what to do, and it's been lauded for it just as much as it's been hated. But like the yin yang symbol, there's a give and take in life, and so that karma, that hell to pay, those chickens coming home to roost, those are upon us now, and this has nothing to do with any business cycle reset. This downturn that we're looking at, that the highest climbers get knocked down first. Those are the tech stocks, but really this is about that melt up based on printed money comes undone and completely.
Yep.
Okay. So if there's,
let's take
a look back at the scenario inside Hidden Levers platform.
Yeah, take a quick look at that. We'll go back to our scenario library here with all of our scenarios, and we'll look at the scenario details here. So we talked a bit about the retest of the lows earlier and how priced in it is. We have the business cycle or the tax plan resetting the cycle and triggering upside from here. We have the downside scenario that we discussed with the S&P not taking quite as much of a hit as the NASDAQ with the peak FANGs downside ugly scenario. And then finally the Fed's QE karma scenario with the worst hit to the S&P of the group, and also coming with a true recession in the ugly scenario here of GDP falling well below baseline, whereas in the peak FANG scenario, GDP just manages to hold on barely outside of a technical recession on the economic side, but falling to a level that would certainly be concerning.
This is a good point to talk about a common question we've gotten asked over the past 9 years. The same way that you have a multivariate regression, right? I can, if I stress test this with a few, maybe you could load up a few portfolios, maybe some model portfolios.
Sure.
While he's doing that, I'll mention that we often get asked, hey, can you combine scenarios? Can you take two scenarios and overlap them the same way you do a multivariate regression? You have two levers and you're seeing the impact of those on a portfolio of investments, or contrasting them on different buckets of assets. So could we do that with scenarios the same way you do it with multiple levers? And the idea, though, is it's just, technology does have its limits, but our imaginations do not. And so for us, a better solution to that overlapping scenarios is to create a new scenario. So, the business cycle sunset really is a combination of narratives on technology and another narrative, competing narrative on interest rates and where that's headed. And so, if you do find that one scenario is not enough to talk about, and the other ones are also, nothing lives on an island here in the Hidden Levers scenario library. They're just thematic upside, downside narratives, if that makes sense. And so for us, again, because there isn't tons of compliance and tons of hoops to jump through, we are economists that came from the throes of Wall Street. We created these narratives to actually manage risk instead of just to get a degree or to get an award. It's in the trenches, and so that's the way we formulate things. Here we do it with pictures and pithy text, but really it was putting derivatives trades on the line based on these exact narratives. And so combining scenarios using a new scenario is a much better concept to us than using technology to make something that looks right. I can do that as a user experience, but that doesn't mean it will be right underneath. So we do want to do that. Are there any questions?
I think we've touched on all the questions as we went today.
Okay. Well, thanks for joining us. I hope you guys don't think Andrew was too awful. I thought he did pretty well. We'll probably have Praveen on next time, or maybe the audience will tell us keep Andrew on and get rid of me. Who knows? We're one team here at Hidden Levers, and the economic analysis bench is super deep. And we don't care for one opinion. We care about the gamut of opinions, and then articulating that as a good, bad, ugly. We think that's the right way to do things. So you're never too bearish or too bullish on things. Very cool-headed and data-focused. Thanks for joining us.